Hey, it's Colin Meeks, and welcome to the Christmas edition of the Financial Advocate Podcast. Merry Christmas Eve for all those who celebrate. Merry Christmas, and if you celebrate something else or have celebrated something else, I wish you happy holidays. And thank you very much for being a podcast listener this year, and I hope we brought you some good information. This is going to be a quick one. I wanted to talk to you today about just this thing called the Santa Claus Rally, and it's one of the most widely discussed seasonal patterns in the stock market just because just has a little holiday feel to it. Before I get into that, though, I wanted to read you a quote from a really cool financial writer. His name's Morgan Housel. And for all those that, we're not stock market timers. We are long-term investors. We index. Our goal is to put together a financial plan for our clients, invest the money accordingly, and just let the market do its thing and through the ups and the downs. And the ups are really easy to get through. It's the downs that a lot of times people get really nervous in. So during the last 100 years, there have been more 10% market pullbacks than there have Christmases. So think about that. There's been more than 100 market pullbacks of more than 10% over the last 100 years. Now, the difference there is we know that Christmas is going to come on December 25th of every year. What we don't know is when or if any of these market pullbacks are going to come. You might have a couple in a year, you might not have any in a year. And that just lends the fact that our philosophy lends more credibility to the fact that our philosophy of being a long-term, stretch it out investor, not a market timer, is what works the best for our clients. So let's get into the Santa Claus rally. And it's a Santa Claus rally is a term coined by a gentleman by the name of Yale Hirsch, and he put it in the Stock Traders Almanac way back in 1972. 72 was the year I was born, so there you go. But it's to describe the tendency for the stock market to rise over a really short period of time around the turn of every year. Obviously, they call it the Santa Claus rally because of Christmas. Now, the period, it takes the last 5 market trading days of December and the first 2 trading days of January, and they just analyze the heck out of this, and they try to say what it means if it does one thing, what it means if it does another. They're taking 7 trading days of the year and trying to make predictions based on it. Now, going back to 1950, the 7-day period has been disproportionately positive for those 7 days. The S&P has posted a gain during approximately 79% of the periods, and the average gain, it's kind of small. It's only 1.3%. What can you glean from that? Well, for me, I can't glean anything from it. 7 days. I mean, you might as well just throw a dart at a board and try to figure it out. It's significantly higher, though, than the average return of positivity for any other random 7-day period throughout the year. So again, there's people that have tested this thing and analyzed it, and that's what they've come up with. So why does this happen? Well, there's no single proven theory, but there are several ideas that people have thrown out over the years. So I'll run through these with you. The first one, obviously, holiday optimism and sentiment. Going into the holidays and after the Christmas holiday and into New Year's, people are just happy. They're spending money. There's this cheer. There's this goodwill. There's, everything's going to be fine. They have these reflections over the holidays that, as opposed to sitting around in a dreary old afternoon in February and thinking, the weather's terrible and I'm not in a good mood and things are looking terrible. Well, during the holidays, people tend to look up. And that leads to more bullish buying activity. People spend money. They think stocks are going to do well. They do all those things associated when you're in a good mood. The second theory is, well, these institutional investors are on vacation. So the big money's not moving things around as much. So the little guy sort of has a bigger effect on the market. It's driven by retail investors as opposed to a Fidelity or a Vanguard moving money around. So there you go. There's number 2. The third thing is they say it's the end of the tax loss harvesting season. Now, we do a little tax harvesting, but it's not like one of our big value propositions with clients. But tax loss harvesting is what a lot of people will do at the end of the year to sort of match up gains and losses and try to time that out. And what it results in is it's uh, a lot of selling in the market where the market does retreat a little bit if that's the effect of it. So the Santa Claus rally sort of takes the opposite effect of that. If that's over now, we can sort of exhale and let the real fun begin. Um, Fourth thing is there's this anticipation of the thing called the January effect. Now, the January effect is completely different than the Santa Claus effect. So if you weren't already thoroughly confused, I'll throw the January effect in there. And that's, some investors buy stocks late in December with the anticipation of this January effect. And a lot of times people will say, well, as January goes, so does the stock market for the rest of the year. And this is a separate phenomenon where things seem to rise in January based on the outlook that people will have for the year. And then the last reason for that Santa Claus effect is they think, well, all these people that got their Christmas bonuses and they were sitting on this cash and they've got all this money that they didn't spend over the holidays. Well, they're going to start to take and invest that because, they also reflected not only on the cheer and the fun over the holidays, but they might have reflected, hey, I really have to start to buckle down and save some money. So all this new money is flowing into the market, and that is going to also rise the tide. So there you go. What does this tell us about our long-term outlook? Well, it doesn't change anything. If those 7 days of the market this year are the worst 7 days that they've ever been, that's still not going to change the way that we advise our clients. If those 7 days are the best 7 days of the year, it's still not going to change the way that we advise our clients. Again, we're not looking at 7 days, we're not looking at 7 weeks, 7 months. I mean, our term is 7 years. Maybe a little shorter than that for some people, but we don't really care 7 days, 7 weeks, 7 months. We care about all those big chunks of the year. So there you have it, Santa Claus effect. This will be something cool to share with your family over the holidays. But if we are selectively taking new clients as our schedule permits, so if anything that we've said on this podcast or any of the other ones throughout the year sort of resonate with you and you'd like to have a conversation, there's never a charge for a conversation. We'll talk for 10 or 15 minutes, see if there's anything that I can do to help you out, and if our cost structure lines up with what you're looking to pay. I'm happy to have that discussion. So, but again, step back from that. I wish you and your family a very Merry Christmas if you celebrate, Happy Holidays if you celebrate something else. Thanks for listening, and we will talk to you our next podcast in 2 weeks. Thank you.